Good afternoon, everybody. All right, let's do it. It is Wednesday, March 1st. And I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure is the same, except I got back into meta on a dip a little bit, so I'm keeping a small position, real small, overnight tonight. Okay, after hours, what do we have going on? We got snow. We got snow down small here a little bit. They beat on earnings, 14 cents versus 4 cents. They beat on revenue by a bit. They authorized a $2 billion stock repurchase program. This is all looking pretty good to me. What they guide down? Guide initial fiscal year 24 product revenue is a little bit light. Snowflake and AWS expand successful partnership by boosting sales collaboration, industry solution alignment, and joint go-to-market strategies. Snowflake, not bad. But real winner here, CRM, crushing it. Crushed earnings, absolutely crushed that EPS number. Solid beat on revenue. Increased share repurchase program to $20 billion. $20 billion. And guidance is solid. Yeah, guidance is solid. That's real good from Salesforce there. Really, really solid from Salesforce. The other big winner out here I'm looking at is Okta. Okta up 12% after hours. EPS was really, really solid beat on Okta. Oh wait, no, they see that's guidance. Never mind, I misread that. They see 2024 adjusted EPS 74 to 79 cents with an estimate of 32 cents. This is a really big beat. They beat on Q1 revenue guidance as well. Really nice. What else do we got? We got DNA out. This thing has not been doing well. That's a Kathy Wood name here. Though they beat on EPS, beat on rev. Guidance is light. Splunk trading down. Splunk down about 4 or 5%. Guidance is a little light. Yeah, Salesforce. Real big winner on this Salesforce. Very nice. Okay, let's jump into today's meeting. So, what were our expectations today? The expectations that I kind of had established were mainly looking for another day of chop. Chop leaning towards the bear side of the market. Is what I was thinking about. So going back over to the daily chart here, we are still within last week's range. So today is Wednesday. We're 3 trading sessions through the week, and we're still within last week's range. Keep emphasizing the importance of last week's high and last week's low. If we lose last week's low, I think it's a real problem that could lead to another leg down. You lose last week's low, and you are losing the backside test that I keep bringing up, the backside test of this downtrend line that started in January 2022 that we broke out of in the beginning of 2023 as the big picture of our chart here is improved. And the big picture of the chart's still intact. You know, we could still create a higher low somewhere between 390 and where we are currently and break back up and, you know, get above 415 and make new highs. From a pure technical perspective on that really big picture, that creates a continuation of the higher high and higher low that we saw with the December low and the February high. That's still in place. But the small picture is not great. Small picture has been downtrending. So we're in such a key pivotal spot right now for this market. And I know the last few trading sessions have been really tricky because we've just been having these kind of choppier range days. But at the same time as we're having these choppier range days, I hope that everyone appreciates actually the importance of the spot that we're in right now, because whether we break up or break down from here, which I said in the morning meeting today that I'm expecting another day of chop, but leaning towards the downside. So I'm actually thinking there's a slightly higher probability to the downside. But that's more because of the internals of what we've been looking like here these last few days. So depending on which way we do break, we will eventually break in one direction or the other. It has a big effect on our big picture. If we break up, which again I think is the lower probability situation at this point, and by break up I really mean a clearing of 405, then you're looking at another potential big picture higher low, higher high that is continuing this little reversal that we've seen on the very big picture of our chart as we've gotten above the 200-day. If that can happen, this 200-day, which is really flattened out, will eventually roll back up. So major consequences if bulls can step in here and create the higher low into this area, especially as we're retesting that downtrend line that I already referenced. There's also a really important spot for bears. Bears want to not create that higher low that I just described. And this would be a good spot to do it too. You know, very roughly just eyeballing this looks like about a 50% pullback or so from the December low to the February high. So this is exactly, and right into the 200-day, this is exactly where bulls want to create that next higher low on the big picture. Bears, if they can break down here, you're not getting your big picture higher low, the small time frame downtrend is still intact, and you're failing on this bigger picture trend line that I really do think leads to another leg down. Most likely somewhere into the 380s. Maybe we're getting a retest of this loose 380 support zone that we had back in the end of December. So this is a really pivotal spot. But again, coming into today's trading session, I thought one more day of chop. What I've been calling for is right now when we're within the range, trade both sides of the market. You can have longs on, you can have shorts on. Pay attention to relative strength. And if you're trading any of that type of stuff, you want to be very conservative on your game plans as far as profit taking goes. I'm always an advocate, always, whether you're short or long, of keeping a little something in case the big move goes in your way. If you've got shorts on from any of these last few days and we end up breaking this important support, this important pivot low from last Friday, last week's range, you might still have shorts at SPY 400 when the SPY is at 380. The opposite's also true. You know, you get a cute little long on and a relatively strong name today, and the market holds the support, breaks its way up, gets above 405, works its way back up to 415, 420. You could still have a long position on from the equivalent of, you know, SPY 395 or whatever when the market's making a new higher high at 420. I'm always an advocate from a game planning perspective of keeping a little something for that big move because big money comes from big moves. With that said, we have to recognize that while we're in this range, we're getting a lot of chop. So when you have chop, inherently it means that you have a higher probability of getting stopped out of the trades that you're taking. So if you go back to the game planning thought process that I always like to implement, which is get that risk covered, right? Get that risk covered, then be in that win-win situation. You're just going to be dealing with a lot more trades here where you eventually get stopped out. And when you're in this type of a choppy market, it means that the way you execute is really important. Because if you execute well, you have a higher probability of getting your risk covered. And that's going to be within an environment where there will be a higher percentage of stop outs because we're not having any sort of real trend. So sure, keep a little bit, short or long, just in case this market breaks. If you're on the right side of the break, you might end up having some really good stock that becomes a lot in the money. But recognize that our expectation for these last several days has been chop. And if you are having a less aggressive game plan, or you're making sure you're getting all your one-to-one kicks to cover your risk, and then you're taking off more to make sure that you're making money even in failed trades, there's nothing I love more than making money in a failed trade. So if you're doing that consistently, that's the right type of game plan when we're not expecting a break. Now, tomorrow that might be different. Tomorrow there becomes a higher probability that the breakdown can give follow through. And again, so why today did I not think that we would really break down today and get the follow through? Why did I think that, highest probability situation was rangy chop, second highest probability I did think was a breakdown, lowest probability coming in today was the market breaking up? Why am I thinking on today's trading session that it's probable that we get one more day of this choppy action as opposed to getting the continuation of the breakdown? It still goes back to our extension rules. We are not so extended that we couldn't have broken out of last week's range and gotten below, and I know we actually ticked below it today, but we're not so extended right now that we couldn't break down through 393.64 and work our way down to 390. We could have. It just, if we broke today, it would have been a very difficult short, I think. Like what I really think is that you want to be pounding the short side of the pavement if we're really clearing below 393.60, and pounding the long side of the pavement if we're able to clear Monday's high / that 405 area, because now you've got the market on your side with those trades. But again, I didn't really think that it would make a great risk reward for that breakdown today, because if you did short, you'd be shorting like $6 of extension is what we figured out in the morning meeting. Even as of right now, the ADMA has come down a little bit further, but the ADMA is at 399.22, and that break, we're looking at, let's just call it 393.50. So about $6 of downside extension is where you're shorting at that point if you want momentum continuation. It's not an impossible short. We get downside of $10 extension. So you could have shorted there. You could have gotten a move to 390 today if real heavy momentum trend was coming in. But on top of that, that short-term tactical, which is another layer of probability that I like to pay attention to. I still have Pat's note available here on my other screen. A short-term tactical, as of yesterday's close, was almost in that green zone. So that means that by the time we gapped down this morning and gapped down and traded lower this morning, you're very quickly in this green zone. So is it as much as I think you should be, again, pounding the short pavement, I think I just invented that expression, on a break of the range of last week to the downside, I also think that having to do that today would not be setting you up for a great risk reward, to be honest, because you're shorting there and you're shorting into $6 of extension. It can go lower, but you also got short-term tactical in the green. It's just very hard. So bottom line is, while that was a possibility, I felt that the higher probability situation, and actually the better situation for bears, would be to not break today, to have a day like we had today. This is going to allow this moving average to catch up a little bit further. Tomorrow morning it'll be, calculating today's session a little further, and it'll be a little bit lower. So I don't know what it's going to be tomorrow, but maybe instead of having $6 of extension on the break of that 393.50, you've got $4 to $5 of extension on the break of that 390.50. That has a very positive effect. And if we could get more rangy action in here, keep in mind that the way that this short-term tactical gets settled is the exact same way in which extension gets settled. It gets settled through time and price. So if the market rips up, then this is going to move up. But if the market moves sideways, this is also going to move up. And that enables this thing to be able to be more supportive of a further market breakdown. So it's exactly what we got. You go to the small time frame. The way I would describe this is a choppy bearish consolidation day. We were very choppy. Initial tick higher was led by the IWM. I was actually really excited at highs for the Russell today. That for a minute, when we were breaking up, I actually thought that my lower probability scenario might play out. Remember, the lower probability scenario that I'm talking about right now is a break to the upside of last week's range, of us really getting above. Again, I think a great starting point is this 401.29 for Monday, but 405 is really the spot. So I was starting to think that, hey, actually, maybe I'm discounting the degree of probability of a breakup. Where's my mistake coming from, is what I was asking myself at one point this morning when the IWM was ripping. It was from an under-analysis of the Russell, which you should never do because the Russell's been the most important index. Maybe instead of starting every morning and afternoon meeting with the SPY, I should be starting every morning and afternoon meeting with the IWM, just because we have so consistently seen this is the leading index. And if you look at the Russell here and you compare it to the SPYs or the Qs, this is so much stronger right now. It's held in so much better. It was relatively strong intraday yesterday. It was really relatively strong again this morning. You know, if you were just looking at the SPYs this morning, first 3 candles, you're like, oh boy, bearish consolidation of the gap down. Not good. Setting up for lower. You look at the Qs, first 3 candles, even weaker. Sell off of the open, okay, fine, little extension hammer. What does that just mean though? Timer price correction to the ADMA, get this little snapback. This candle's not great. You're like, okay, you know, SPYs are looking bad, Qs are looking bad. If that's the only universe you're looking at, you're, you know, lining up for that breakdown. You look at this IWM and you go, oh wow, Russell did not break lows in the second candle. It broke up, went green, tested the ADMA. This is a good continuation candle of that momentum. Beautiful momentum on this 945 candle, giving more than a 15-minute price correction, really breaking up. We traded up to 189.40. What's the level on the daily chart I need to break? 190 is important. What's the high of this negative Maribozu? 191.34. 191.34. I'm $2 away from that, and this Russell looks like this. It's like very, very noticeable. So I'm analyzing that at 945, 950 this morning. I'm going, wow, you know, maybe I underrepresented the probability that this market can break higher, because I'm very confident that if the IWM breaks up, it's going to pull the SPYs and Qs up also. Why am I very confident about that? Because I've seen it time and time and time and time again over the course of the last year and a half now. It's been a very consistent thing. And even on a daily chart and on an intraday basis. And even on the intraday basis, like there were some really good longs here actually early in the day that we were able to recognize because of that IWM leadership. And then as I saw us moving higher, I also reminded myself that I felt that the highest probability was chop. And when you are in a choppy market or a range-based market, inherently what it means is that when the market looks its best is usually when it's about to go down, and when the market looks its worst is when it's usually about to go up. That's what range-bound chop markets do. Of course, eventually, that range, that chop will break in one direction or the other, and when you actually get that break, that's when you get the big moves. So you got to be prepared for that as well. But that then goes back to the big picture game plan, the big picture thought process. That's why that big picture game plan is so important, because you say to yourself, like, all right, you know, take the market when it was looking its worst today, take the market when it was at lows today, and if I think that's a higher probability that we have a chop or range-bound market, that means that not only am I not going to get followed through to the downside when I think the market's looking the worst, but I'm probably actually going to get a break higher. And the opposite can be true also, though. If I've got the big picture game plan that says, hey, you know, today's the day where I'm no longer extended enough on this daily chart or whatever it is that I can get the breakout or the breakdown, then you look at this chart when it's at its absolute worst and you say, what other shorts can I find to prepare myself for this market breaking lower? So it just goes back to why even if you're a pure day trader, you have to be looking at daily charts. You have to be thinking about the big picture, because that's the difference today, I think, on when the market had a couple of spots today, especially with the SPYs, where we looked really bad. I mean, we even got below last week's range. We actually broke below that low by like 30 cents or so. Probably suckered some people in. But we never had confirmation from the IWM. We never had confirmation from the Qs. Neither of them, right? I don't think the Qs broke, right? 290.05, 290.20. Yeah, 290.20. Qs held. IWM is really not even close. So given those factors, that leads to a higher probability of actually like a false breakdown for the SPYs, which is really what happened. And then we got that false breakdown, and again, this is once again how range-bound markets work. I was typing into the VTF at 12:30 today. Wow, you know, that is when I started saying today's close is going to be really important. I'm typing in like, wow, like today's close is important because I'm looking where we're trading, and it's only 12:30. If this consolidation, which deteriorated to the downside, if this broke up, which it easily could have, I mean, the high of this range is 396.25. If we close between 396.50 and 397 today, I would have been left with a big downside hammer doji that shook out last week's low. and an IWM that's relatively strong. So then all of a sudden what happens is the probabilities really switch very quickly. Where I'm looking at this market, today, like I was viewing today as a choppy day that sets us up for the next breakdown. But if after today, I've got a 30-cent break of SPY's low from last week that fails to give any follow through, and we close at 397, and I got a hammer doji on a failed breakdown. From a failed move comes a fast move. I could very quickly be testing Monday's high again. So, Tesla getting smoked a little bit right now on their earnings day. Not earnings day, I'm sorry, investor day. So that's the big picture. And again, this is just how markets work, and this is how we have to be prepared for them. Not every day is created equal. I say it all the time. You can't treat every day the same. You can't be equally aggressive on every day. You have to game plan for yourself based on the expectations of that trading session. All traders always want every day to be a phenomenal day where there's a massive amount of reward opportunity in the market. New traders consistently make the mistake of trading every single day as if it's going to be a trend day, big move day. They trade equally aggressive across the board. Experienced, successful traders recognize that, and I don't know what the numbers are, but I probably would say, if you took a random set of 10 days, probably 8 of them, 9 of them, something like that, are actually these more difficult, choppy-ish type of trading sessions where you don't get that massive trend and massive follow-through. They're setting up. They're setup days. And they set up that other smaller percentage of days which create the big move. So this week has been a trickier week because we've just been within last week's range. We have had appropriate expectations that the market's going to be choppy and not give any follow-through. But the market being choppy and not giving any follow-through, again, what does it do? It eventually creates the setup that's going to give the big day. I can use a recent example here of this consolidation at the end of December and very beginning of January. I'm not sure if anyone else remembers trading this. I sure do. These days in here were all very tricky days. Why are they tricky days? It's obvious. We were stuck in a range. Close on lows, close on highs, do nothing. Next day, big ranging day. I don't know what happened that day. Next day after that, inside day. Day after that, close on lows. Day after that, finally the breakout. Right? Look at how many days that were probably tricky in here that set up this day. And again, for myself, capturing this day set up a move that for me made me a lot of P&L. If I'm going to be totally honest with you guys, like I did like really, really well in January, and that's because I was ready for the breakout when it occurred, and then I followed the game plan that we have for reward maximization. I was greedy with things because the market told me now is the time to be greedy. And I remember us, having the expectation of this breakout occurring on that day. I honestly don't remember why, but I remember, communicating to you guys in that morning meeting. I thought today could be the day, and then it actually went, and it was the day. And I got really paid for it. But again, it's look at all of what I had to go through to set myself up for this. And it doesn't mean that I can't make money on these days. It doesn't mean that I can't make money on these days. It's just much more difficult. How do I make money on these days? How do we make money over the course of the last few days? It's more difficult, but the focus is where's the relative strength, where's the relative weakness? Let's have good execution. Let's find names that are in play. And you do that. Yesterday was probably a better day for our list. I didn't love my list for today. I think there was a couple things that worked out pretty well. I know Wynn Resorts was like a really solid one from the list today for along off this 110, off this daily chart breakout with the positive news that was coming out of Macau. But that's all you need. I'm not getting the whole market to support me, but I get a couple win resorts. I get a couple, Twilios that, from like yesterday. They're like, again, we had a few great call outs for those momentum moves in the beginning of the day. I was able to make, even though, it's like a blip on the radar, I made pretty good money in SI yesterday, kind of trading it around. Absolutely, these last trading sessions are the more difficult days, but by doing a good job with your research, identifying the names in play, identifying the important execution levels, and then trading them and managing your risk, you still can find ways to make a living for yourself over the course of these last few days, or over the course of this consolidation that we had in December and January, while you wait for the opportunity where the big money actually comes in. And this is where the big money comes in. And that's the hardest part in a lot of ways. And I think it's especially the hardest part for new traders. Not that I'm God's gift to trading by any means or anything like that. I'm wrong all the time. I make mistakes all the time. I have losing trades all the time. I'm always very honest about them. But I've hit a point in my trading career where I have really recognized that I can be patient and sit on my hands more and not be aggressive when I've created a game plan expectation based off of the pieces of information that we all look at that says today's not the day. And then I can be significantly more aggressive and be involved in things and be much, much heavier when I recognize that today is the day. And again, I'm not perfect. I still miss it. But over the course of the last year and a half, I think I haven't caught them all, but I've done a pretty good job on recognizing the big days as they kind of come and taking advantage of it. There's certainly been ones that I've missed. I was not, as much as I'm talking about pressing the short side, I was not trying to press the short side on the break of last week's range today. I was not sitting here ready to whack shorts through 393.50 because I just didn't think it was the day. I could have easily been wrong. We're $6 extended coming into today. We have seen, I don't know how many instances, but we've probably seen, one instance every 2 months or something like that of the market becoming, $10 to $12 extended over the course of the last year and a half. So I easily could have missed a catalyst day today where we break down and get down to 390, 389, and I was failing to press the short button because of my thought process that the risk reward wasn't good, and then I kind of missed that move. That has also happened to me over the course of the last year and a half. I don't catch them all, but that's the big portion of it. Is again having that right game plan where you know when to be aggressive, when not to be aggressive, when I should sit on my hands more or focus on names that are in play only, and then otherwise be more aggressive. And that is all I've got. Bill saying, I see there's a bunch of other things. Bill saying, just to lump on to what Derrick said, it was a big change in my trading when I learned when to slam the pedal to the metal and when not to touch it. Yeah, for sure. And no problem, Eddie. I'm happy to answer any questions that anybody has. I see that there's a couple in there already. Just give me 1 second on one thing on my other screen. Okay, from DJ. Pfizer did not give a good entry today for a long. Oh, wow. But hypothetically, suppose it had a clean breakthrough intraday highs at 10 a.m. Would that justify an entry, or are you just too far from yesterday's low at that point? I like these setups, but sometimes the entry is too far from the hammer low to use that as a stop, and I'm not sure if I should use a different stop or ditch it altogether. How often do you enter with a higher stop on these setups, if ever? Sure, so this is a great question. And I'm not sure if it was you, DJ. It may have been, and that's maybe why you're asking the question. Someone brought up Pfizer in the morning meeting today as a potential long opportunity because it's gotten smoked and then had a higher volume kind of hammer type candlestick yesterday. You got good extension from the ADMA, so you are looking for kind of continuation of this hammer. There's a good probability after a higher volume hammer with extension that you get a snapback to the ADMA on the daily. So that's what you're looking for. And then your question basically is at 10 a.m. is when you're looking for your entry. If we could have broken through highs, If we broke through intraday highs, or I guess if we broke through like this shooting star high that came in on the 5-minute chart, you're thinking you could use it as an entry? Maybe. And I actually don't love that as a small time frame entry execution strategy, to be honest with you, but it's not terrible either. So regardless of the actual trade setup in here, I just want to get to the root of your question, which is, you know, using a small time frame stop loss is pretty much what you're asking me. You're like, I want to be able to buy Pfizer and give it down to yesterday's low because the daily chart is giving me this hammer and that makes it the right stop on the daily chart. But I don't want to be buying, you know, $40.80 and giving it all the way down to $40.10. It's not a good risk reward for Pfizer when I'm just taking a counter trend trade and looking for a snapback to the ADMA. So can I use a smaller time frame stop loss instead of using the big time frame stop loss? And the answer is absolutely. This is what I love to do. I love to find the daily setup and then trade it with risk on the small time frame. I will sometimes on smaller positions give risk all the way down to the big time frame, but that's not my preference. You should be able to make more money if you have better risk reward. I don't know how else to say that. You should be able to make more money if you get better risk reward. You should be able to take more size if you have smaller risk. So if you had a smaller time frame entry here with a smaller time frame stop loss, that could let you take much more size than if you're given the stop all the way down to yesterday's low. So what I like to do, and you know, we do all this daily chart work, is I want to be able to find the trade idea based on what the daily chart's telling me, but execute on the 5-minute, which sometimes means you could get stopped out of a trade that works still on the daily chart, just works without you. But think about how much better your risk reward is going to be if you found an entry somewhere in here. Let's say you wanted to risk $100 in the trade. I don't know. You wanted to risk $100 in the trade, and you find an entry at 40.80, and you can use a stop loss at 40.70. You could take 1,000 shares on that. Versus if you have an entry at 40.80 and you got to give it down to, you know, 40.10, you can only take 100 shares on that, or like 100. And you can take an odd lot, I guess, for the same dollar risk technically, but we can't trade odd lots in these names if you're a professional trader. Think about how much more you can do with that 1,000 shares. Think about how much more, you know, you get your risk covered. You got 500 shares left. Think about how much more money you're going to be able to make into this up move, and how much more versatile you're going to be able to be from a game planning perspective. You sell 500 to 1-to-1. Your next target, I'm looking for this ADMA on the daily, and you hold that for that. And you sell 200 there, something like that. And then your next target is, I'm looking for the 21. I'm looking for a retest of the breakdown area of $43 in conjunction with the 21 EMA for my second target. I'm going to take another 100 or 200 shares off there. And now at this point, you know, my stock's at $43. I'm in from $40.80. I'm keeping this next 100 or 200 shares just in case my retracement becomes a reversal, and this thing reverses back up to $55, which is where it was in December. And now you get that happening to you every once in a while, and you just made big money. So yeah, I would much prefer doing it that way actually than using the bigger time frame stop loss. Whew. From Kyle, a couple questions. Could you explain the Macau earnings like? No, so Macau is a place. Macau is a place, a territory, whatever, that is owned by China in the same way that it's like an autonomous region that's owned by China, basically like very similar to Hong Kong or Taiwan, to be totally honest. And I hope I did not offend anyone who is Taiwanese, but I'm going to just go with the official stance of the United States, which we've been recently trying to deny, which is that Taiwan is part of China. So it's like an autonomous region that's owned by China where they allow gambling. So it's like China's Las Vegas. You can't gamble in mainland China, but you can go on vacation to Macau and you can gamble. So Wynn Resorts and LVS, they have, you know, a lot of casinos there. And we regularly see, I mean, I was just going based off what Pat said in his morning research. I don't know, you can find it. You can find it somewhere this morning. I don't remember where, but you can scroll back to, you know, 7:30, 8 a.m. when Pat's posting all that really good news and information in there for us, and find, I'm trying to scroll through, but there's no way I find this at the same time. And you can just find, because Pat gives us the news, I can't remember, something positive about numbers coming out of Macau. And since I understand, because we have seen previously over the course of the last couple of years since COVID hit, Chinese government shut down Macau, had a really big negative impact on Wynn and LVS because they got big businesses there. And then as Macau has come back online, it helped LVS and Wynn perform. So that news kind of coming out at that time, also this morning would be a positive thing for those stocks. Question number 2. When putting a buy stop in a name that's a little spready, will the buy stop fill once the inside ask reaches the price? No, it triggers the second a print goes off on that price. So not the inside ask, a print. You need the inside ask to be at or above your stop loss price, and then a print to actually go off. I've had stocks spread past my stop loss and never actually trigger it and then come in my favor. It's scary. It's also part of the reason why I don't like trading spready stocks. I'm just reading the rest of your question. No, it does not. It will not trigger the stop when the ask or the inside offer reaches the stop loss price. It will trigger when an actual print in the tape goes off on your price or above your price. And again, you got to be careful with those thin names because that's where you're going to get the most amount of slippage. SI with bad news. They're delaying a 10K. Oof. God, I don't have a position in that anymore. And 2 days ago. From Rex. I was in NVIDIA short at 9:45. Okay, inside 5 and down here. And relatively weak. Not bouncing as well as the market. NVIDIA was relatively weak with a $10 billion offering yesterday. I cheated a little bit and shorted at 9:45 before the inside 5 when I see it rejected the 5-minute ADMA. Okay, I'm fine with that. With the 10 a.m. ISM lower than expected, NVIDIA sold off even more. I was looking at the ISM number and thinking to add a little bit more short into my position, thinking it could break through 230. Okay, that happened. However, before the break, it poked higher back to the last 5-minute high and had me stopped my thought. I'm not sure what that means. Had me stop my thought. I think that means that you never actually executed the trade, and now you decided not to add through 230. Would you mind talking a little bit about how you would execute the trade? Would it be better to add short after it broke 230? Yeah, you could add through 230. 230 is the big level. It's relatively weak. You already have some stock. I would usually treat that as a new trade. So if I was shorting through 230 when it broke, I probably would use the high of like that bar when it broke maybe as my stop loss. Whereas my initial stock, I'd be still using the bigger stop loss for it. I probably would use 2 stops. But I totally support everything that you're talking about here. If you are holding a position that you haven't covered your risk before the 10 a.m. number, would you trim down your position before the number hits? I don't do that. Or just hold and see where the number takes a stock. So I don't do that. I hold and see where the number takes my stock, which definitely is gambling a little bit. I would say that I try to be more conscious about important economic numbers before they happen and not do trades right before them too often. So like if I know there's an important number coming out at 10 a.m., I'm shying away from new executions at 9:58 generally. But if I already had something on from 9:45, I just didn't get my 1-to-1 kick, I don't change anything. I got my stop loss in, I got my 1-to-1 in, and we'll see what happens. So that's how I do it. Kyle, yep. Macau Gaming Inspection and Coordination Bureau reported February gross revenues up 33% year over year to HKD, I think it stands for Hong Kong dollar, 10.3 billion versus minus 8% in February 2022. Yeah, so looking solid. All right. looks like I got through the questions for everybody. Hope everyone had a good day today. Again, I know it was a choppy trading session. I hope everyone learned from this afternoon meeting. All we can do is continue to work and continue to improve every day. That's the key to this business. I'm still continuing to work and continuing to improve every day, and you guys are as well. If you got the YouTube up, click that thumbs up sign for me. I'm still trying to build that out. If you know anyone that's interested in trading but maybe doesn't want to jump into professional trading, tell them about the YouTube so they can follow along in our afternoon meetings once in a while and the content that I put in there. And that's all she wrote. Have a great night. See you all tomorrow.